Welcome back. Let's connect with Rahul Bajoria, Chief India Economist at Barclays, who joins in to share his views on the union budget. Rahul, good morning. Let's understand how you're looking at the government's plan this time around. Clearly a focus to drive Capex growth. And do you think that with this push for Capex, this fiscal consolidation path that has been laid out, the overall Capex cycle for India Inc. continues to look very strong?
Hi, morning. Yeah, I would broadly agree with that. I think in the budget, the finance minister has laid out a lot of fair amount of continuity as far as the emphasis on capex spending is concerned. I think there's also, a tacit, explanation that the government does think that, private capex might take a bit while to recover. So, the government will continue to play a fairly dominant role in driving at least public infra spending. And, they will also look to open up areas where private capex can come in. So I think the combination of this emphasis on continuity of public spending and specific infra projects along with opening up new areas is basically where the capex spend could kind of come from. Apart from that, I think the emphasis on kind of keeping revenue projections reasonably conservative is also possibly going to give us a little bit more tailwind as we go through the next year. But overall, I think it was a budget mostly about continuing from the themes that they had embarked on in the previous couple of years.
And what do you believe is going to be the outlook on the bond yields in light of what has been declared in the budget, as well as how you see them trending going forward?
Yeah, so bond markets have been particularly volatile, in the last couple of weeks, not just because of the domestic, behavior, but also because of what's been happening globally. Our sense is that in an environment where, oil prices remain reasonably elevated, and there are concerns about the RBI, also starting to move closer towards an exit to their very, very accommodative monetary policy stance. We reckon that, the pressure on yields is obviously to inch higher, although we have already seen a fair amount of increase in yields in the last few days. So maybe there is, some room for consolidation around the current, 6.75, 7% levels. But the general bias will be to see curves remaining reasonably steep in an environment where inflation is high and, growth is expected to be fairly reasonably strong.
Good morning, Nayantara here. So just picking up from that, when we read about reports that are coming in from a Goldman Sachs to others that are predicting anything from 5 to 7 rate hikes. There was one report yesterday that came out for 7 rate hikes by the US Fed. Back home for the 9th of February RBI monetary policy outcome, what are you penciling in? Because I'm guessing the markets will also be looking forward to that now after the union budget.
Morning, Nayantara. So we think, the RBI has been very, very emphatic in, saying that they are not in the same boat as the other major central banks globally. We do feel that, a lot of inflation in India is driven by imported sources, over which, monetary policy has very little impact as such, right? And in an environment where growth support is going to be the mantra of the day, we think that RBI will, move towards, further removal of the accommodative policy, but we don't see room for very aggressive tightening as well. So for the February meeting itself, we are looking at, maybe a 20-25 basis point increase in the reverse repo. So some normalization in the corridor, but the overall guidance from the RBI is going to be that, it's going to be a very, very tepid, a normalization cycle from them through this year.
Okay, so let's see what happens on 9th of February. That's, Barclays just predicting almost a 25 basis point rate hike as early as 9th of February. Thanks a lot for joining us live today on the market a day after the union budget.